Hi there and welcome to the Stockscores Market Minutes for January 28th, 2013. This week I'm going to show you how to buy stocks at wholesale prices and sell at retail prices. That probably sounds a little confusing at this point, but you'll get what I mean when we look at the charts. Reminder to subscribe to my weekly newsletter at stockscores.com/newsletters.asp and subscribe to this YouTube channel so you can get instant updates when I upload a new video. All right, let's get into the analysis. Don't chase stocks higher. The higher stocks go, the further they have to fall. I like to buy stocks when they are breaking out of sideways trading patterns because those sideways trading patterns give the stock a foundation of safety. It gives you a floor that the stocks should hold above, provided they have something changing fundamentally, or at least in the perception of what is going on fundamentally. Now, we want to look for stocks behaving abnormally because that's where the action is. We've talked about that in recent weeks. We want to find that heat in the market, but we also want to make sure that we're getting into these stocks early in the trend and then sell to the public when there is euphoria. This is the idea of buying wholesale and selling retail. Now, here's a couple of charts of stocks that were hot today. And at the blue arrows, you can see the point where those stocks first started to behave abnormally and started to break from low price volatility. What I mean by low price volatility is sideways, boring trading. I've highlighted that with the red and green lines, showing that the stock was in an optimistic pattern, but still trending sideways. And then at the blue arrow, we see this increase in interest among investors. The stocks jump up in price, the volume starts trading more heavily. Now what happens is these stocks tend to get the attention of the market when they're trading really crazy volume like both of these stocks did today, but that's after the stock has already risen significantly. You can see that in the case of Radio Shack, the stock had gone up almost 50% from the blue arrow until the close today. And on Carrick's, it was even much more, certainly more than 100% gain into the close today. The point is these stocks start showing us that there's something going on early, and that's when we want to buy stocks. We don't want to chase stocks when they've been going up for 2, 3, 4 days, when they've made these significant gains already. The percentage gain isn't really what's important. It's how long have these stocks been going up. We want to get them as close to their foundation as possible. All right, let's get into the analysis. And this week, I'm taking a long-term view of the charts, looking at the 5-year weekly chart, just to show you the big picture on these different charts that we look at each week. Here's a chart of the S&P 500 ETF SPY, and I've highlighted what's called a rising wedge pattern, where the bottoms, which is the green line, are rising quicker than the tops at the upward sloping red line. You'll notice also that the market is coming into resistance from the highs of 2008. Now we're a little bit farther to go until we get to the real highs of 2007, but I do think while the market is very strong right now and looks good, we should be wary because that rising wedge pattern shows that buyer enthusiasm is getting tired, and we are close to resistance at that 155 mark on the SPY. So while I'm still bullish on the market, I do think a little bit of caution is warranted here because we're running into all kinds of reasons for the buyers to lose their enthusiasm and for the sellers to take back control. Now that could happen in a week, it could happen in a month. It's just something you want to watch for. Anytime there's weakness though, I have noticed that the market gets pretty trigger happy and there'll be a quick sharp move downward only to succumb to the big buyers, which is largely the institutional funds who are protecting the market right now. The TSX is, I think, in a better condition than the S&P 500 because it's really just starting its upward move. It really only started that upward trend 3 or 4 weeks ago, and it has much more room up to resistance than the S&P 500. However, I think in order for the TSX to do well, we need commodity prices to start improving. Now, as we'll see in a moment, the US dollar is weakening, and that's a positive for commodities, and certainly the energy sector has started to improve, but the mining sector is still lagging, and that's largely because gold remains in a somewhat lackluster looking chart. Here's the Russell 2000, and it made a break from an ascending triangle at the start of the year. Now that pattern is better than the rising wedge because it is more of an optimistic pattern rather than a pattern of the buyers getting tired like the rising wedge that we saw on the S&P. The good point here is that this market looks likely to go higher, and I suspect that money may simply rotate out of the large caps, which have been the leaders, and start to come into the more small cap area where the retail investor tends to like to trade. And that's a good thing. It makes the market a lot easier to trade, a lot more fun, but I don't think we're there yet. I'm still not seeing a lot of opportunity in the small cap space, although the sector has been doing well the last 4 weeks. I think it's just getting started, and the retail investor is not yet fully back to this market. The TLT chart, which is the 20-year bond, U.S. Treasury bond ETF, is a positive for stocks, as we've talked about in recent weeks. It broke down from its pennant and is likely to continue to fall, but it hasn't been a rush out of this, and so I'm not thinking that a ton of money is coming in off the sidelines just yet, but I do think that the trend has begun, and that will be supportive of stocks in the longer run. The US dollar is in a long-term bearish trend and in a short-term bearish trend as well. It has some support here, and if it can break up through that red line, the short red line at $22 on the UUP ETF, well, then we might go up and test that long-term downward trend line. But I think it's more likely that the market will break down through the green line and move toward testing those lows at $21 on the ETF. And that'll be a positive for commodities. That should help the Canadian market, but we still want to watch for that break. Right now, the US dollar trading in a very narrow range of volatility, and that tends to come before a big price move, so we want to watch this chart closely. Euro has been rising over the last couple of months. It's now coming up to some resistance where it may get stuck, and that could be supportive for the US dollar. We'll have to keep an eye on that, but as it stands right now, the buyers are in control of the euro. Gold is in I'll call it a long-term sideways trend, because if you really look at what's happened over the last year and a half, gold's just been kind of grinding sideways. But over the last few months, it's been cruising lower, and I think it's more likely to test those lows at the green line than it is to test the highs. However, we want to look for the market to tell us what to do, and if it breaks that downward sloping trend line, which is the little red line that I've drawn in the chart there, then we want to change our view and become optimistic, as it should likely go up and test the longer term resistance at about 172 on the ETF. Now, it tried to break that downward trend line last week. It failed, and therefore the sellers remain in control of gold in the short term. Oil has been rising for the last 4 or 5 weeks, but in the context of the last few years, you can see that oil remains in a somewhat bearish pattern, given that the tops are falling over time. Now, if the if the global economy is actually getting better, like many think it is, we may see that red line broken, but I'm not going to get optimistic about the global economy improving until I see that red line broken, because that will be a break of that cycle of falling tops, and that will be quite critical for oil to turn around. Now, in the short term, I like how oil's behaving, but it's got a lot of work to do to really get through that long-term downward trend line. So my outlook then is bullish, but with caution on US stocks, simply because the large caps are coming into some resistance. We may simply see money rotate out of the big stocks and into the smaller stocks, and the overall market kind of cruise sideways while the investors start to speculate on some of those smaller companies. And that actually is a more fun market to trade, so I'm hopeful that that's what's going to happen. Canadian stocks I'm bullish on simply because they have more upside potential, and we are starting to see people get interested in that commodity sector again, although it's still in its early stages. I remain bearish on gold, but that could change within a week if we get a break of that downward trend line. Oil I'm bullish in the short term. Longer term, I think it's still got lots of work to do. The buyers are in control of the stock market, but their enthusiasm may come down with US stocks as the market rallies into resistance. Canadian stocks have better upside potential, but need improving commodity prices in order to catch up to the US market. Well, that has been the Stockscores Market Minutes for January 28th, 2013. Have a great week in the market and trade well.